Sound check, please. Am I coming through? Am I coming through? We are live. Okay. What we're going to talk about tonight, Illumina earnings. How did we do? What a roller coaster. We're going to talk about that. We're going to talk about the Qs. We added more to our short of the triple Qs. We're going to talk about the whys behind that. Even Franklin. How's the sound check here, Franklin? Am I good? I keep disconnecting this and I get worried about that it's not working. Okay. Qs. Why we added to the Qs. We're going to talk more about that. We're going to talk about the Fed's balance sheet. We're going to talk about headlines, inflation, corporate layoffs. It just goes on and goes on. So let's get to it. So Illumina, which is a DNA sequence. Thank you, William. Thank you, Franklin. Illumina, which is a DNA sequencing company. Normally, I wouldn't trade the earnings of this company, but the options today were paying very, very well. I was able to get a decent premium at a greater than a 3 standard deviation move on the share price. What's this 3 standard deviation move? Well, you have a probability of profit of 3 ranges that we typically use. One is your 1 standard, 68.2%, 68.27% chance of probability of profit, or probability of trading in the money, I should say. A 2 standard, a 95.45% probability of trading in the money. I said, if I'm going to trade Illumina, which I've never traded earnings before, I'm going with a 3 standard deviation move. And in fact, we even went below the 3 standard deviation move to the downside and above to the upside. So it was a greater than 3 standard deviation move. Let's talk about the trade. Okay, so here's the trade. These are the actual confirmations. So we the open, meaning we're the banker, we're the casino, we're not the gambler. Well, frankly, tonight we are the gambler. We sold the 275 calls and we sold the 185 puts, both. Again, 3 standard deviations away from where the shares were trading at the end of business today. We were paid a credit on 15 contracts of 75 cents. Not a bad payday, assuming that your strike doesn't get challenged in either direction. Then you have a problem and it's got to be managed. So what happened? So after hours, they reported earnings and it wasn't good. So, I kind of expected that they were either very, very bad or very, very good. Why? It's because it's rare you ever get a decent bid greater than a 3 standard deviation move. There's not a market out there. So the reason why there's a market is that there were a lot of people expecting a big, big move in Illumina. They got it. So after hours, the shares plunged to a low of about 22%, even greater than that, hitting a low of 174. My strike price was at 185. So I was well below, the share price is well below even my strike, setting up for a disaster for tomorrow morning. So what I did is this. I said, you know what? Let's prepare to hedge the position. We're probably going to get a short covering rally because, again, I believe that a lot of what was happening after hours was already priced into the share price. So I put in a bid to sell at this 20-period moving average on a 5-minute chart, the 195. I shorted Illumina at 195 because what if this is a short covering rally and we faded to go back down to my strike price? Well, before I shorted, I had no hedge. I was completely 100% exposed. Now I have mitigated my exposure for the most part to be neutral. I can close out the options trade, assuming that we don't trade down below 185 tomorrow for a profit. Ideally, I close the short position out flat, or maybe even for a profit, or maybe even a small loss. But either way, what we're doing here is that we're managing our risk. I did not short. Remember, I sold 15 contracts. That's 1,500 shares. But I only shorted 400 shares. Why? It's because I don't need to short 1,500 shares to protect my position. That sounds crazy, I know, but there's something called a delta, meaning the percentage that the option will move relative to the share price of the stock. So if I shorted at 195, I have roughly, let's say, a 50 delta. I have 400 shares. So that gives me a decent hedge on the rest of my position. So I'm feeling good about the trade now. I was not looking forward to it earlier, but I was shocked to get filled on that short. So it worked out, and the trade is actually setting up to look pretty good from both the options perspective, because right now, if we open up at 192 tomorrow, that's a profitable trade. I could take the trade off the table because our call is definitely profitable, and at current, our put is profitable. Now, if we open up at 192.25, I could take the option off the table and also book a profit on the short as well, because we shorted at 195. So that's Illumina. Forward-looking guidance. I didn't see much on forward-looking guidance. Oh, actually, I did. It was not good. Forward-looking guidance. They lowered their full year. Yeah. Illumina shares plunged 22% after hours on 2Q loss. It wasn't a horrible loss. It didn't justify a 22% drop. It was not a good report, but again, people knew what this was gonna happen, either a major beat or a major miss. That's the only reason why you're running a market that was so liquid at a 3 standard deviation move. So they slashed their fiscal year outlook. So that is Illumina. Members, we'll talk more about strategy, about getting out of this trade tomorrow. And let's get to why we shorted more QQQs. So last week, was it last week? Sunday or last Thursday, one of the two, I forget. I did a live stream about opening up a hedge on the Qs. Now, what we were using was a here, I'll share with you so you could see. Again, this is the actual trade. We're very transparent here. Very, very transparent. Did I not post it? Did I not? Guys, I didn't post that trade. I guess I wasn't transparent today. I don't see it here. Frankly, did I not post or any member on that talent? Did I not post this trade? I guess I didn't if it's not here. Shit. Sorry, family-friendly show. All right, so we opened more triple Qs to the short side. We sold a deep out of the money call option while simultaneously purchasing a deep in the money option. So what does the sale of the option deep out of the money do? Well, it helps finance the trade. So the other day, I was when I was shopping for opportunities to short, I always take a look at implied volatility, right? An option when it's below 50 in terms of implied volatility is considered to be, sorry about that, I hate that noise. It's considered to be a cheap option. Now, last week when we opened up this trade, the Qs had around a 23 handle on their IV percentile. They actually were trading as high as a 30 handle this afternoon. They've dropped back down to a 25 handle. But what we're seeing is gradual pressure to the upside on implied volatility. So I want to begin adding more now when the options are cheap. So that way, when the options expand, meaning If the market rolls over and the options become very much in demand by speculators, well, they're going to bid up and they're going to pay top dollar for those options that I'm buying now, what I could consider to be on a discount. So I would rather get somewhat long or short of the Qs now by getting long of put options before the poop hits the fan. So we're going to talk about the whys, why I added more today. And this is really just a headline. I pulled it up after hours, but it was in the chart of the 10-year yield. Yields hit session high after ugly trailing 30-year bond auction. Those are long-term bonds. So long-term yield moved up higher. So the Federal Reserve has very, very little control about managing 20-year, 30-year bond yields. They can control short-term yields. So this is a problem. This is a major problem because you'll remember that I've been talking ad nauseum about the yield curve. For those folks just joining in, you don't know who I am or what a yield curve is, I will share. I will explain. I know half of you out there, the constant viewers, are going like this. Oh, Christ, not again. Do we have to hear this again? Yes. Yes, we do. Yes, we do. For the benefit of the new people out there, we must educate. We have to do it. All right. For those who are new, the yield curve, which is a measure of 2-year yields versus the 30-year yield. When the yield curve is inverted, meaning 2-year yields are paying more than the 30-year, that's a major problem. Every time we've been in this situation, we have resulted in a recession and a major, major stock market correction since 1955. I think for exception of one time. So the last time we were live, I was talking about the yield curve and how it had dropped to new monthly lower lows. Now, with today's 30-year bond auction, and even it began yesterday, the yield curve began to steepen. And this is what I always preach about, is that it's okay if the 30-year bond yield declines. Don't go panicking. Don't worry. It's all good. It's inverting. You don't have to worry now. Just get ready because things are going to get real fast in a few months. So now the yield curve really has my attention because what we saw today, we opened up the session today. This is a monthly chart, by the way, monthly chart. We opened up right at the very lows or just off of the lows of the month. We have retraced. We were down, I forget where we were, but we were down significantly lower than where we are trading right now on the yield curve. In fact, let's go to a daily chart and take a look at the major move today to the upside. I got to clean this up. And here you have it, folks. Pressure, hockey stick. All right. So what this is the yield curve starting to say, okay, this is not working. Bond buyers are demanding more yield at the long end of the yield curve. They want to get paid for their risk. They have not been getting paid. So I've been sitting here and I go live with you folks, which is great. I have market wraps with members, which is great. And I pontificate. I always wonder what's going to be the pin that pricks this stock market rally. What's going to be the name of the event, like a COVID event, the .com event, a great financial crisis event? What's going to be the name for this event? And I think I have it. And I think the event is going to be awkward pause. Chrome, let me out of here. It's going to be this. Now, I went into the week. I had done this is the 10-year yield weekly chart. I had done a live stream with members, not a live stream, the week ahead commentary with members. It comes out every Saturday. And I said, there are a couple of charts here that really, really worry me. One is the US dollar, which really doesn't worry me as much anymore. The one that worried me more was the 10-year yield. And I said, you know, we were looking at this candlestick here, and I drew these lines, upper band of resistance, lower band of support, which is a classic bull flag setup. And I said, you know what? We begin to break out above this upper band of resistance. We're going to have a major problem because we're going to rip through a three handle. If we rip through a three handle, meaning 3% on the 10-year yield, tech stocks are going to get clobbered. They're going to at least pause, and as we move through the three handle, they're going to roll over. Then once we get up into 3.4, 3.5, everything rolls over. It was like this back in 2018, and that's when we had that major here. Let's go back to 2018 on the yield curve really quick. Right here. So this is 28. Oh, that's what I'm sorry. Wrong. Is that right? Wrong. Wrong year. Sorry about that. Here. This is what I wanted right here. So let's memorialize this. So you remember the Federal Reserve since 2015 had been raising rates gradually. Over the course of 3 years, they raised them as much as the Federal Reserve has in the past 3 months, or 6 months, I should say. And the stock market, which is highlighted here in orange, rolled over and it fell 20% in the month of December alone in 2018. So yields are about where they were back then, a little bit less. Here's the difference. Yeah, right here, 2018. We hit them and we backed off. Those highs back there. That was October of 2018. So here's the difference is this. Back in 2018, the Federal Reserve was rolling off debt off their balance sheet. So here's October of 2018. This is the debt on the Federal Reserve's balance sheet. Their debt back then was $4,176,906,000,000 to be exact. What is it today? $8,479,138,000,000 to be exact. So what's my point? My point is this, is that with all this debt that needed to get funded back here, and the stock market said, no bueno in 2018 and had its taper tantrum. What's going to happen now that the debt has doubled? What's going to happen now when the 10-year yield starts breaking through 3.5 on the 10-year? What happens then? Do you think equities shrug it off and move up higher or lower? The other thing we need to keep in mind about the difference between now and 2018 is that you had a CPI back in 2018 that was below 2%. Now it's above 9%. Or actually, let me retract that. It's about 8.5. using the government's official number, which we know should be double if you use the same metrics as they did back in 1970 through the 1980s. Enough on that point. So what we're seeing here, and this goes back to why I added to the short of the Qs today. What we're seeing here is a 10-year yield breaking out on a weekly time frame. And I got to tell you, folks, this is one good looking chart. Now, does that mean we go straight up next week, the week thereafter, and blow out 3.5 on the 10-year yield? No, probably not. We could bounce around here, then move up higher. But I do believe that there's short-term pullback to short-term bear market on yields within the larger, longer-term bull market on yields is alive and well. This pullback is a pullback that, were it in equity, should be bought. And this is going to create a major, major nightmare for equities moving forward. Now, let's talk a little bit about the Qs. And I'm sitting here in the luxury of my studio office, den, and I have to say to myself, when are you wrong? Or when do you lean into the trade? So we opened up this trade last week when we hit two key resistance levels. One, monthly resistance, right? We hit that upper band of resistance. I said, you know what? Let's begin bear operations now. Not as a net short position, but as, you know what? Let's take advantage of this opportunity. If we break out, I could always stop out. But if we roll over here, well, I'm in a strong position. So fast forward to today, where you're looking at a market which opened up very, very strong. Here's the weekly chart. At current, we are trading above two major resistance levels. One trading day left to go. Now, if we manage to close up tomorrow and we close above these two key resistance levels, well, then I may have to take a small loss and then look to re-enter if, in fact, we rally up to 330 to 340, and I can always lean back into the trade. But the key is, do we close above these resistance levels or do we roll over? Today's close was not wonderful. Daily chart. Daily chart. There we go. We had a bearish key reversal bar on the day. Volume was light, but it looks as though MACD is really losing momentum now. It looks as though we're probably going to probe lower. And if, in fact, we do manage to close back down below these two resistance levels tomorrow, then I'm not going to add to the short. I'm not ready to do that yet. I'll wait until there's a bit of blood in the street, and then we'll go looking to lean in short more aggressively, and we'll look to take some longs off the table and really lighten up here and say, okay, let's see where the market's going to take us. We're comfortable right now because we have our hedge on. We're short the Qs. If we wake up one morning and we see the Dow futures, S&P futures down bigly, well, we're already protected to a certain extent. But as I see the markets weaken up, and I'm not saying they're definitely going to, for all I know, we're going to melt up from here. I don't know. I'm stupid. For all I know, they're going to melt up. All I'm waiting for is the market to send me a signal. And if we fail to hold these support levels to tomorrow, and we begin to break down to new daily and weekly lows next week, and volume begins to rise to the downside, we need to look to add to our shorts. So those are the Qs. That's what we're doing. And let's take some comments, see what people are thinking. I said something funny? Good. I'm glad I made somebody laugh. Hey, Pete. Tom Lou, I bought FNGD. What is that? The Fang Bear? Oh, yeah. 3 times bear. Duh. I didn't read the whole thing. All right, cool. We'll take a look at that one later on. Tom Lu again. But I keep Fangdu on hand 3 times. Okay, is that optionable, Tom? It is a twilight zone in everything. Confused indeed. No doubt. Very well put. TZ Burton, good evening to you, my friend. Thank you for being here. Goldman lowered gold from 2,500 to 1950. Buy gold. That's Goldman telling you. You got to buy gold. You got to buy it. Thank you, Goldman Sachs. Well, I don't have an account with them. Nobody has an account with them except for the whales. Yet they give us free information all the time. It's so considerate of Goldman Sachs. 2009 is the low. As I remember, JP Morgan was 16. Yep. Could the Fed and BIB banks have an agreement to keep buying gold to control the yield, keeping it below 3%? Buying bonds. You never know. But I don't think it's going to happen. I think again, it goes back to what I said before, Seymour, is that it's very, very difficult. The U.S. Treasury market is so deep, it's so huge, that to control the 30-year bond yield takes massive liquidity. And I don't know whether or not they could do that. Maybe they can. I don't think that they can. I don't think that Jamie Dimon would do it. Maybe the other banks, because they're sucking off the government teat, they would do it. But guys like Jamie Dimon, probably not. But again, I'm open-minded. Big banks, not bib. Gotcha. Okay. Clark. Some FX guys saying market downturn likely attributed to yen weakness versus USD. Apparently, since July, USD has become more pegged to CAD. CAD has helped prop up markets. You can see if you compare the charts. All right, so CAD is the Canadian dollar versus the US dollar. The yen was in a very, very long-term bearish downtrend. It did bottom out. It did go up, but I haven't looked at it in several days. In fact, we traded it. We traded it long several weeks ago and made money on it and exited. We traded the options on. It's good. It's not very liquid with the options. But thanks for that comment, though. CAD strength. Okay, thank you. And that CAD strength is bearish for commodities. And the reason why commodities or the CAD is going up is because of commodity prices. Hello, Bob and gang. I'm late again. No worries, Trader Isaac. We missed you as always. Thanks, Tom. Not optional? Optional? Yeah. Buy them. GDRX has over 30% shorts. Good info. The market may pull back for me. I lean to the upside. You could be right. I'm not making a call here. I'm just sharing what my observations are. And, one trading day left to go, but I don't know how this gets ignored. Not by technicians. If I was called in to consult on what my thoughts were on where the direction of yields are going, all I would do is pull out this chart. It's very, very simple. And if they ask what is my number one concern about equities moving forward, you could say inflation, yeah, definitely. But inflation plus rising yields, that's a big problem. Bearish oil. I don't know about that. Clark. You could be right, but I haven't looked at oil today. Valero was strong. I had to roll out of that position. I had a Valero position on. We'll look at it. We'll look at it because natural gas surged. I mean, really up big this week. And I'm wondering if it's more of a broader move in energy, because I'm going to go over an article in a moment out of Saudi Arabia where they plan on cutting production. Lacking estrogen site. Yeah. I love when the ladies, you have Trish, Sherry, and a few other ladies that join in. It's great to have them, but I know they watch sometimes on the restream. So ladies, if you're out there, we miss you. And if you're on, say hello. Rivian outlook is, but don't they report earnings tomorrow? Just too much losses ahead means more share dilution. More talking about CAD's strength could be bearish for oil. Yeah. In Canadian dollar terms, yeah. In CAD terms, yeah. In dollar terms, the way the dollar's trading right now, the dollar's weak, and it's reflected in it's bullish for oil, I should say. No, I didn't say short Rivian. You're referring to Seymour's comment. Oh no, that wasn't Seymour. That was Tom's comment. Yeah, we'll take a look at Rivian. I'm not saying short it yet, but we'll take a look at it. We can make the call then. All right, let's move on. So whenever I wake up in the morning and I see this, future storm higher is NASDAQ, bull spark, FOMO chase. You got to worry about a reversal day, especially when you're leaning into big resistance levels, which I just shared with you on the Qs. So be careful of the bright green futures. I think that it's a sucker's play to chase. And I always think this. Don't go chasing the pre-market futures. It's very bad. Producer prices dip in July, but remain near record highs. Folks, this is a very important data point. You know, we're going to get bouts of good news, right? And we do have a double top here, and we do have a confirmation breakdown on the producer price index. For those not familiar, the producer price index, that's the cost of inflation at the producer level. So it's good to see this number coming down some. And believe me, the politicians are going to seize this. They're going to say, we killed inflation. No. They took office in 2020. It's quintupled, right? Through the roof still. It's going to be that way through the midterms. It will be this way through Election Day 2024. White House gasoline prices are about to surge. I didn't read this yet. I just want to scroll through it. I'm so late. I was working on the after hours trade in Illumina. That's why I was late tonight. Holding firm. Good. Okay, so let's see what they have to say here. Regional supplies sank to the lowest level in a decade, raising the risk of shortages. Bam. Supplies are at near all-time lows, records going back to 1993. Wow. Commenting on the recent absurd demand reports, EIA energy data showing gasoline usage apparently well below 2020 levels, despite all the non-recession and jobs booms. And even as refineries are working at incredibly high capacity levels, diesel stocks are low and exports are also low. These are all numbers. All right. So what they're saying here is that we have a problem. Demand is still there, while down on a relative basis. Stockpiles are low, allowing the price to move up higher. Now, sticking with the energy trade for a moment, I mentioned this earlier. OPEC sets the stage for output cuts, sees oil market tipping into surplus and clash with IEA forecasts. We're going to go to a chart of oil in a few minutes. Egg prices. Our little egg company, Cal-Maine Foods, did a reversal day today and moved up higher. The egg prices, the price of eggs is up 47% as food costs in the U.S. spiral out of control. We're not going to go over all this. What time do we have? 6:39. I want to do chart requests. Grocery inflation hits highest level in 43 years despite Biden's zero inflation messaging. I don't make this up. This woman here, she's a Federal Reserve president. She came out the other day and said, I'm living well now that the inflation is coming down. Basically, she's a pawn for the regime, and she is trying to back the president. Loser. All right, initial jobless claims surged to highest since November. Look at this move. So the trend is clear and defined. Initial jobless claims continue to rise. I think that last jobs report was complete BS. There was a big diversion between the household survey and the establishment survey. Household survey came in with job losses, but the establishment survey, the one controlled by the federal government, that came in with a big beat. George Gammon did a video on this. I was watching it last night, and I stopped right where we started talking about the household survey. Let me see if I could pull that up. Yeah, this is it. Now, we discussed this over the weekend, and I came out with the same conclusion that George did, that the numbers were rigged. Here you go.
The established survey going back to 2021 pretty much goes up in a straight line. Just amazing how consistently the United States economy can create jobs. But the household survey tells a little bit different story. It does go up, it stays very consistent until we get to about March of 2022, where the establishment survey continues to go straight up in that very neat and tidy line, but the household survey starts to flatline and actually goes down. And if you look at the total numbers since March of 2022, the establishment survey says that the United States economy has created 1.6 million additional jobs, compared to the household survey that says we have 168,000 less
negative
jobs. Yeah. Just to reiterate, to make sure that we're all on the same page, the establishment number, which is the one the mainstream media and the politicians use, say that we have created 1.6 million jobs in the United States since March of 2022, where the household survey says that we have seen the job market contract. We have 168,000 fewer jobs today than we had in March of 2022. And as you guys know, this number would be very consistent with those main data points we talked about in step number 1, the inversion of the yield curve, 2, consecutive quarters of negative real GDP growth, and the jobless claims going up. So what are the main differences that would account for this discrepancy? First and foremost, the establishment survey double counts jobs. So let's just think this through. What happens is the bureaucrats call up businesses and they say, okay, what's your payroll look like? Oh, you had 20 people on your payroll month or last quarter. All right, today you've got 22 people. Well, that means we have increased the number of people working by 2. Where the household survey calls actual individuals and say, hey, are you working? Are you working? So what ends up happening is the one survey double counts the amount of people working because it doesn't distinguish if someone has 2, 3, 4, 5, 100 jobs.
Don't yell at me, woman. I drop my uniform wherever I want. I work 15 jobs and I don't have time for your foolishness. When I come home, I'm tired, damn it.
Where the household survey would just count that
all right.
as one person.
So I dropped a link in the box. I think you get the point. You know, George goes over a lot of what we go over here, right? So we're on the same page 1,000%. The thing to remember is that the double counting of people is a major problem, because I've shared in past live streams where you have a lot of people that are working now 2 full-time jobs, and they go into the payroll data. So that one person that was working a full-time job, took on a second job, is now counted in the establishment survey as being a new employee. No, it's the same guy. He's working 2 jobs. The guy can't make ends meet because inflation's going through the roof. That's the problem here. So you look at this and you got to start saying to yourself, if the federal government is going to pull out these numbers and they're going to say we're growing jobs, the job market's booming, we are not in recession. Okay. So what the bond market hears is that, wow, things must be really heating up. You need higher rates because you're doing so well. And look at what the bond market is telling us. They want higher interest rates because the government is saying we're doing very, very well here. There's no recession here. They changed the very definition of recession. Okay. Now it's time to call BS, and they're going to do it. This is going to rip through a 3.5 handle, folks. Buckle up, because what it does, we were talking about this earlier, about all the who was it? Goldman Sachs came out lowering the price of gold. And you have another JP Morgan. JP Morgan, they get caught doing this in the silver markets, in the gold market, over and over and over again. It just doesn't stop. And they're going to continue to do it because they're never, ever really punished for it. JP Morgan, precious metal trader, found guilty of spoofing, had power to manipulate the global price of gold. So the COMEX, all this paper gold that's out there is the reason why gold is not flying. Why will they not stop this behavior? Why will the federal government not stop this behavior when they can? The last thing the federal government and the Federal Reserve want is gold ripping up higher and seeing the dollar go this way and real money, gold, going that way. That is the worst public relations nightmare for them. They cannot have it. They cannot have it. They will do anything to prevent that from happening. But at some point in time, they're going to lose control, and you're going to see a massive short squeeze in the gold market. All right. We did this. We spoke about George. Let's go over a few charts. I'm going to blow through the weekly charts really quick. A lot of it we already did. TLT, this is a 20-year bond price. I mentioned this over several weeks. I said this to members on the week ahead commentary. I said, guys, you know, this to me looks like a bear flag setup. And I had to kind of capitulate a few weeks ago, actually not a few weeks ago, 2 weeks ago, when we broke out. Come on. When we broke out and closed above 118. But last week, I was able to reclaim some of my dignity because we had a breakout point failure, also known as a bull trap. We are now heading back down lower. It appears as though I was correct. This is a bear flag setup, and we are now rolling over on the TLT. What happens when the TLT moves lower? Bond yields go this way. The chip market weekly chart. We're in a triangle formation. You're going to get backing, filling, backing, filling. Don't read too much into this. The US dollar. This is what we were waiting for. A breakdown on the dollar. We haven't completely done it yet, but we did negate last week's lower lows. Excuse me, we did negate last week's bullish candlestick by putting in new weekly lower lows. Let's see what the dollar is doing after hours. Dollar's down. We could quite possibly have a W formation form here. But it's looking weak. Lower highs, lower lows. So we're hoping for a breakdown on the dollar bull ETF UUP below 28. Probably not this week, maybe next week. Note how the Stokes are breaking down. Lower highs, double top, and now we have lower lows. Moving on. All right, so we're watching the VIX very, very closely. The VIX is down on the week with the S&Ps being up on the week. Makes sense, good stuff. S&Ps are at resistance. But let's take a closer look at the VIX using a daily chart. Using a daily chart. There we go. Okay, we're up on the session. A little bit of a fade on the day. So we recaptured support. So this descending downtrend channel, we closed below the lower band yesterday, recaptured it today, bullish for VIX, bearish for stocks. The Dow Transport, strong week, up nearly 3.25%. We were higher, and we have faded a bit to just above the 50-period moving average, which has now begun to hook up, which is bullish. Dow Jones Industrial Average up over 1.5%. We're stopped at 33,500. One trading day left to go. Let's see what happens. This volume is absolutely incorrect. That's wrong. Qs we went over. Banks, strong move up higher on the week. They like rising yields. They like rising yields until the stock market says, no bueno, we can't take it anymore. And then they'll roll over with the rest of the stock market. But until that occurs, banks are going to move up higher. Watch for 35.75 on the XLF. Let's go to a daily chart here. Names like BlackRock broke out this week. In fact, I had a signal or alert that fired off on Goldman Sachs either today or yesterday. I forget which. Days just blend together. Stokes looking fabulous here. This is a short covering rally. You can tell by the gaps up. Volume below average. It's okay volume, but be careful. We're going to get a pullback here. I don't like short covering rallies like that. Technology. Now, this is a very, very bullish chart here, folks. No matter what I say, you know, the chart here is saying, and this trade's pretty tightly correlated with the triple Qs. We have a breakout on technology. So we broke out last week. We did a retest. This week we're holding. Do we get follow through to the upside, or do we close down below 144? Let's get 146 on the XLK. If we close down below 146 on the XLK, that puts in jeopardy this breakout. But for right now, it's looking okay. Let's go to a daily chart. See how we closed out the session. Not good. Bearish key reversal bar. Volume light though. So we're not going to do a chicken little moment. The sky is not falling, but we're just preparing for the worst and hoping for the best. That's all. Awesome. Let's give Bob a thumbs up. Thank you. Hit the like button. Yes, please smash the like button. He can be poolside with a high ball instead of in his basement with us. Yeah, absolutely outstanding point. Yoga Mac, hey, good to see you, pal. Good to see you. No worries, man. All right, let's continue on here. Semis. Semis are down on the week. I'm very surprised about this. And this is a tell. This is a major tell because here, let's update this chart. We broke out last week. Maybe we're just doing a retest this week. Okay, I could buy into this. We just don't want to see the SMH fall back and close back down below 230. A close on the SMH on a weekly time frame below 230, that's a major problem for the stock market as a whole. LABU, we booked profits on this trade, 3/4 profits. We kept a quarter position on. We hit resistance. We backed off. That's why we got out of the trade in advance of that sell-off. Daily chart, one of our members, Lewis, sold covered calls. Good enough. He hedged. Longer term, I think we're moving up here. We're just going to consolidate. Daily chart, new higher high, but we reversed. This is an outside bar. One of my top 5 favorite candlestick patterns, new to me. Link below, 5 top candlestick patterns. Free. That's what I wanted to say. Free. Link below. Check it out. 5-part video tutorial. Energy. Energy is breaking out this week, folks. So this is where we want to take a pause and we want to say, okay, you know, is what we're seeing in the headlines being borne out in the chart prices? It's important to do that. And what am I talking about? Well, I just went over an article about the Saudis cutting production. So that should be very oil bullish, right? It should be bullish for the U.S. energy producers. What is energy doing? It's a major breakout on a weekly time frame. Take a look at this. How's our volume? Volume is very light. Price action looking awesome. Let's go to a daily chart here. Daily chart breakout. We were in a triangle formation. We broke out. And this is why we had to roll out of our Valero trade. It closed above its 50-day moving average. So Valero looking good. Energy's looking good. What about crude? Is the sell-off over or has it just begun? Well, I got to tell you, folks. It's looking pretty bullish to me. One trading day left to go. Now, as I draw my trend lines here, if I could ask you to head on over, gently tap the like button, subscribe to the channel, tell a friend. And what we're looking at here is a probable breakout on oil prices. So if you're a guy like me looking at this chart, you live in New York, you live in the Northeast, God forbid, you live in the Northeast. I don't have it saved. Odd. Living in the Northeast and you're saying, wow, the winter's coming. Is it time to back up the truck? Literally, back up the truck on home heating oil? Oh, yeah. I got to tell my wife to call the oil company and load up the tank. So, you know, the CPI came out the other day, and here, let's go over this for a second. Let's talk about this. And I think members will back me up here. I called the fact that CPI was going to come in lower in July. I think it's going to come in lower for August. Why? Energy prices are still down for the month of August. These prices are coming off their lows, but by the time the end of August hits, you're still going to have energy prices that are significantly below their highs. The problem is October's read of September's numbers, if I'm accurate here, and we get a breakout on home heating oil, gasoline, oil prices, natural gas prices, because the market's not going to wait for the September CPI report to come out to question whether or not inflation is back on the rise. They don't need to. I do it myself. So if I could do it, the guys on Wall Street could do it. And if you begin to see a breakout above this upper band of resistance and the downtrend is over and we see a resumption of the longer term bull market in home heating oil, energy prices in general, well, you got to factor in that energy prices are going to take it on the chin September moving forward. So why would you wait? You might as well get ready right here, right now, and forget about the July report. That's history. The focal point that we need to focus on is the here and now. And what the chart is telling us is that this wants to go up. So if this goes up and you see a move higher on the 10-year yield out of this, note how the formation is pretty much exactly the same. 10-year yield breaking out, weekly time frame, bull flag setup, oil prices, bear flag, I keep saying bear flag, bull flag setup, big weekly reversal bar, oil, home heating oil, same deal. Let's continue. Gasoline prices, let's get crazy. I haven't looked at this. I'm willing to bet, though, there it is. You got your reversal bar. So we got to ask ourselves, what are we waiting for us to go building hedges on our portfolio? What are we waiting for to happen for us to expect that next leg down? Because all these charts that I've been going over are telling us you better buckle up because these prices want to go up higher. Do we take out not all-time highs? Do we take out the recent highs? Actually, these are all-time highs in nominal terms, not in real terms. When you adjust for inflation, these are not all-time highs. So we need to get prepared now. In short, I don't want to be Debbie Downer here, but the purpose that you're here, I think, is to be told the truth of what we should expect and not listen to this nitwit. I just by chance, I happened to watch 5 minutes, and that's all I could stand, of Jim Cramer last night. And the condescending, matter-of-fact attitude on the guy. Oh, yeah. Stocks, they've rallied. They think they're going to rally more. Loser. So Let's take a look at natural gas. Ooh. Natural gas. Is this right? No, it's an individual company. I knew that didn't look right. UNG. Let's bring up UNG. Buckle up. There's a saying, and I don't use it enough. I used to say it all the time. But the markets send you signals. You could choose to ignore them, say that technical analysis is nonsense, or you could take your crayon out and say, you know what? At some point, I'm going to need to take action here. And the time is very, very close. Now, on natural gas, it's very, very volatile. Now, if we break down below this lower band of support here, let's call it at 69.50, it becomes a short. But right now, this is a consolidation that's getting ready for a breakout. I don't like these Stokes. I'm suspect of it. But natural gas is very volatile, so I give it a little bit of deference. But these energy charts are a major problem because remember, the key reason of as to why inflation has come in these past couple of months at the core headline this past month is because energy prices came in. That's the only reason. Food prices came in a little bit, but when you take a look at the DBA food prices, look at this chart. One trading day left to go. Weekly chart, big breakout on the week. And on the day, a major breakout yesterday. Big gap up. We were watching it. So food prices are going back up. Energy is going back up. It's not going to be seen in the CPI data until September, folks. That report comes out in October. What are you going to do? Right? Learn the charts. Don't wait for the establishment to give you information you should have acted on months ago. Okay, please. So if you're not subscribed to the channel, please subscribe to the channel at a bare minimum. Join me, 14-day free trial offer, and you also get TrendSpider for free. We're going to go to that now. Let's leave it off with gold, and we'll go to some chart requests. Everybody wants to hear about gold. Weekly view on gold. We're up. I'm not loving it, to be honest with you. I'm long of gold. I own gold. Would I buy it here? No. I think it's had a nice run off of its lows. I don't like the price action today on the gold mining stocks. In fact, we sold at the money covered calls on NUGT today, and it paid off. Thank God we did. So I don't like the topping action here. You saw it last week. You have sellers above. They're not appreciating what the gold market is not getting yet. Here, I'm going to illustrate. What the gold market is worried about is this. Remember this. We just spoke about in great detail the 10-year yield, right? The gold market knows yields are going up. But I got to tell you, the gold market is pretty stupid because they refuse to look back at history. They refuse to do it. That is our edge over other traders, and I'll share with you why. They are not capitalizing on the pullback of the US dollar. We spoke about this already. Normally, gold goes the inverse direction of the US dollar. Now, yeah, gold is up on the week, but not even a percentage point, whereas the dollar is down over 1.25% on the week. Gold should be ripping through the ceiling on this technical failure here on gold. It's not. What is it worried about? It's worried about this chart here. It's worried about the Federal Reserve is going to raise interest rates. The Federal Reserve, to fight inflation using The Fed funds rate must raise the Fed funds rate above the rate of inflation. That's above 8%. We're nowhere near that. We're nowhere near that. And we can't get anywhere near it because if we were to normalize interest rates, the amount of interest payment alone on our debt would be the equivalent of the U.S. defense budget every single year, and that's interest only, not 1 penny of principal. I don't make it up. It was like that when I got here. So I'll show you a chart to illustrate exactly what I'm talking about, because pictures speak 1,000 words. I'm going to take you back to the 1970s, 1980s. Get ready. We're going back into the Wayback Time Machine. Click. Quarterly chart, Dow Jones Industrial Average. You may be saying, what the heck does this have to do with the price of what's going on here and now? Why am I wasting my time? Stick around. Hit the like button. Subscribe. Quarterly chart, overlaid here, CPI, Consumer Price Index, similar to what we're looking at right now, right? Going from the lower left to the upper right. US dollar. We're looking at this time frame here, 1971, 72 to 1982, 10-year window. Inflation. What just happened in this time frame? 1971, it was August. Nixon took us off the gold standard. What happened immediately? The US dollar initially declined, then stabilized, and then it rolled over. So here is the Dow Jones Industrial Average rolling over. Why? Yields are moving, CPI is moving up higher. US dollar moving lower. Where's my, somebody change this. How dare they? How dare they? Trying to make a dramatic point here, and I don't have the proper chart up. Dare somebody change my... We're going to make yields appropriate for the time frame. Purple haze, 1970s, Jimi Hendrix, purple haze, yields in purple. Folks, overlaid here in gold, in this time frame of stagflation, what we're in right now, gold moved up higher. What was also moving up higher? Purple haze, 10-year yield, moving up higher. So if these gold traders would stop being such wimps and take a step back, take a look at the correlation between the 10-year yield, Dow Jones Industrial Average, and gold versus the US dollar back in the same time frame that we're looking at right now, they'd say, we have nothing to worry about. We have nothing. The only time we have to worry is when the Fed funds rate gets above the rate of inflation, as it did in 1981, and then you got a major problem for gold, because that's when it crashed. Because that's when Paul Volcker killed inflation. We're nowhere near that. We haven't even begun yet. That is my show. It's really hot. Let's do some chart requests. Let's say hello to people. Richard, welcome. Clark, winter is coming. Wood pellets and for the euros. Yeah. There is great value in tonight's episode. Thank you, Bob. Thank you, Seymour. Appreciate it. Very good insight, Bob. Much appreciated. You're very welcome, Chuck. Yeah, you know, we need to take appropriate comparisons and measure them. Is it appropriate to be worried about not buying gold or not holding gold now because you're worried about the yield going up? Not if the yield is not above the rate of inflation. It's as simple as that. So it drives me crazy. All right, let's do some chart requests. I'm going to log off because, man, it's hot, and I'm probably going to go jump in the pool. All right, I know one of them that was up was Rivian. Short Rivian? No, definitely not short Rivian. No. And again, I believe they report earnings tomorrow, unless they already reported them. I know it's this week. Now, Rivian's looking good here. In fact, right now, we're right at resistance, 38.71 daily chart. Folks, we're using TrendSpider, 35% discount code below. Definitely don't short Rivian here. We broke out today. Do not short it. It looks like it wants to go higher. Again, I believe earnings are tomorrow, so be forewarned. We have a binary event that is in front of us, so I would not trade it in advance of earnings. Thank you, Franklin. Thanks for being here, pal. Appreciate it, as always. CDE. Oh, did they change the symbol? Is this the same as Core de Flow Mining, or is this a different company? Because I didn't recognize the symbol. There's another company that's begins with Core. All right, we're going to begin with a weekly chart. I don't like the daily chart, but let's go to a weekly chart first. I see. Thanks, Clark. I think we've done going down here. Our VWAP, our volume weighted moving average, which is going to connect the lows of recent lows, is moving up higher. RSI, higher lows. Stokes moving up higher. Yes, we're off the highs of the week. That is a problem. So we need to set parameters as to where we would buy. I think we could buy on a close above $3.23 daily chart. Let's see if we have a setup here. No, we had a failed breakout. We have resistance above. These are the automated trend lines. Click of a button. We know we have resistance above, but we also have support immediately below. VWAP in orange, and in blue, we have support. Oh, I didn't, I screwed this up. I got to redo this. I'll do it later on. I don't want I want little sensitivity. Can I change it? I can't change it. Let's get rid of this. I'll redo this later on. I don't want to waste your time. So I think it's looking good longer term. It's a recovery play. You're going to get a lot of backing and filling. Wait for your support levels. Nibble there. Where's your support level? You're at one right now at the VWAP. But if you get down to, this is rising, down to $3 to $3.15, I think you can nibble there and then add far more aggressively on a breakout above 327 and then on a breakout above 340, let's say 340 per share. Leg into the position. I wanted to take a look at FNGD. This is the short ETF or the FANG names. At historic support. How do I know? I've never looked at this chart before in my life. Click of a button, take it off, put it back on. We're at support. I think this is a buy with a tight stop right below the lows of the week. Add more on a close above this VWAP. Daily view. Attempting a breakout here. It's in the middle of no man's land. If we close above 43.70, I think it becomes a buy, but keep in mind that this upper band of resistance is declining. So 41.70 tomorrow, it's going to be a lower number on Monday, Tuesday, et cetera, et cetera. So it is declining. And with that, folks, I'm going to say everybody have an awesome night. Thanks for being here. Smash the like button. Join us tomorrow. We are going to be maybe going live tomorrow morning, early morning. But let's see how my trade is doing on Illumina. Yeah, it's pulling back. Thank God we hedged this trade. So we're looking pretty good right now as we proceed into the open tomorrow. Folks, you're awesome. I value you. Thank you. Hit the like button, subscribe. Check out our 14-day free trial offer. TrendSpider link below. 7-day free trial offer with them. You get 14 days with me. And if you don't know me, you check out my 5-part video tutorial, my top 5 favorite candlestick patterns, free below. Use the link. Have a profitable trading day tomorrow. Have an awesome weekend. Be well.